What if I told you that $158 per month, the cost of your streaming subscriptions and a few coffee runs, could make you a millionaire? I'm not talking about lottery tickets. I'm talking about boring, proven mathematics that has worked for decades. Here's something that will blow your mind. A 25-year-old investing $158 monthly will retire with $1 million. But a 50-year-old trying to reach that same goal? They need to invest $2,413 every single month. That's over 15 times more money for the exact same outcome. By the end of this video, you'll know the exact monthly amount you need to invest to retire rich, regardless of your current age or income. And I'll show you why waiting even one more year is silently stealing tens of thousands of dollars from your future retirement. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let's start with the mathematical magic that makes all of this possible. Compound interest. Albert Einstein allegedly called it the eighth wonder of the world, and once you see these numbers, you'll understand why. Compound interest isn't just earning interest on your money, it's earning interest on your interest, creating a snowball effect that becomes absolutely explosive over time. Let me show you what happens when you invest just $100 per month. After 20 years at 8% returns, you'll have $58,902. That's 2.5 times what you actually contributed. Not bad, right? But watch what happens when we extend the timeline. After 30 years, that same $100 monthly becomes $149,036, over 4 times your contributions. And here's where it gets absolutely wild. After 40 years, you're sitting on $349,101 at 8% returns, or an incredible $632,408 at 10% returns. That's over 13 times your actual money. You contributed $48,000 total, but compound interest added over $580,000 to your account. This is why I say you're not buying stocks or bonds or index funds. You're buying time. And time is the only investment that compounds exponentially. Now let me show you something that might make you uncomfortable, but it's absolutely critical you understand this. I call this the table of regret, and it shows exactly how much you need to invest monthly to accumulate $1 million by age 65, assuming 10% annual returns. If you start at age 20, you need just $95 per month. Start at 25, $158 monthly. Age 30 requires $263. Age 35 jumps to $442. By age 40, you need $754 every month. Age 45 demands $1,317. And if you wait until age 50, you must invest $2,413 monthly just to catch up. Let that sink in. A 30-year delay from age 20 to age 50 doesn't increase your required investment by 30% or even 300%. It increases it by 2,530%. The person starting at 50 must invest 25.3 times more every single month than the person who started at 20 to reach the identical retirement goal. This is the irreplaceable cost of time, and no amount of money can buy it back. Here's a story that really drives this home. Imagine two friends, Sarah and Mike. Sarah starts investing $100 monthly at age 25 and continues for 40 years. Mike waits until age 45 and invests $200 monthly for 20 years. Sarah invests $48,000 total and retires with $349,000. Mike invests the same $48,000 but retires with only $65,000. Same total contributions, but Sarah has 5 times more wealth simply because she started earlier. Time beats money every single time. So what can small amounts actually build in the real world? Let's look at 3 practical scenarios that anyone can implement. First, the coffee sacrifice. $50 per month. This is literally one less dinner out per week or canceling one subscription service. Over 40 years at 8% returns, this tiny sacrifice grows to $174,550. At 10% returns, it becomes $316,204. You're sacrificing around $600 per year in current spending to gain over $300,000 in retirement wealth. Second scenario, the subscription strategy. $100 monthly equals canceling 3 streaming services or skipping 2 takeout meals per week. This represents less than 2% of a $60,000 salary, yet it produces $349,101 over 40 years at 8%, or $632,408 at 10%. Think about that. 2% of your income, invested consistently, creates over $500,000 in retirement wealth. Third scenario, the serious saver investing $200 monthly. This might require more discipline, maybe packing lunch 3 days per week and cutting discretionary spending, but the payoff is extraordinary. Over 40 years at 8% returns, you accumulate $698,202. You're approaching $700,000 by simply investing less than 2% of a $60,000 annual salary. These aren't hypothetical numbers. This is basic mathematics that has been proven over decades of market history. Now, here's the critical question. How do you turn that accumulated wealth into actual retirement income you can live on? This is where the 4% rule comes in, and it's one of the most important concepts in retirement planning. The 4% rule states that you can safely withdraw 4% of your retirement portfolio in the first year, then adjust that amount for inflation each subsequent year, and your money has a 90 to 95% probability of lasting 30 years or more. Let me show you what this means in real numbers. A $300,000 portfolio generates $12,000 annually, or $1,000 per month. $500,000 produces $20,000 per year, about $1,667 monthly. $750,000 gives you $30,000 annually, $2,500 per month. And the coveted $1 million portfolio generates $40,000 per year, or $3,333 monthly. But here's what makes this truly powerful. You're probably going to receive Social Security benefits too. The average Social Security payment is around $1,500 to $2,000 monthly. So if you accumulate that $698,000 portfolio from investing $200 monthly over 40 years, you can withdraw $27,928 annually using the 4% rule. Add Social Security of roughly $25,000 per year, and you're looking at total retirement income of around $55,000 annually. That's a genuinely comfortable retirement in most American cities, achieved by investing less than 2% of a median salary starting in your 20s. Let me share the 3 wealth multipliers that will dramatically accelerate your journey to retirement riches. Multiplier number 1, index funds. This is perhaps the most important investment decision you'll ever make. Index funds are collections of hundreds or thousands of stocks that you can buy in a single transaction. Here's the shocking truth that the financial industry doesn't want you to know. Between 85 and 90% of professional money managers, the people in expensive suits managing billions of dollars, fail to beat a simple index fund over 20-year periods. Why? Because they charge massive fees, usually 1 to 2% annually, and those fees compound negatively against you just like interest compounds positively for you. Meanwhile, the best index funds charge between 0.03 and 0.1% per year. I'm talking about funds like Vanguard Total Stock Market Index with expense ratio of 0.04%, or Schwab US Broad Market ETF at 0.03%. A simple portfolio of 70% US Stock Index Fund, 20% International Stock Index Fund, and 10% Bond Index Fund will outperform the vast majority of expensive actively managed funds while costing you almost nothing in fees. Multiplier number 2, tax-advantaged accounts. This is where you can legally keep massive amounts of money that would otherwise go to taxes. For 2025, you can contribute up to $23,500 to a 401k or $7,000 to an IRA. Here's the real impact. If you invest $300 monthly in a regular taxable account, you'll accumulate around $530,000 over 40 years after paying capital gains taxes. But invest that same $300 monthly in a Roth IRA where growth is completely tax-free, and you'll have $698,000. That's $168,000 of additional wealth simply by using the right account type. It's literally free money from the government for being smart about where you invest. And if your employer offers a 401k match, capturing it is absolutely non-negotiable. A typical 5% employer match represents an instant 100% return on your investment. You cannot find that return anywhere else in the financial universe. If your employer matches 5% and you're not contributing at least that amount, you're voluntarily giving away free money. Multiplier number 3. Dollar cost averaging. This is the automatic investing strategy that makes you a better investor without requiring any skill or market timing. Here's how it works. You invest the same dollar amount every single month, regardless of whether the market is up or down. When prices are high, your fixed dollar amount buys fewer shares. When prices drop, that same dollar amount automatically buys more shares. You're mathematically forced to buy low without having to predict anything. Research consistently shows that dollar cost averaging produces better returns than trying to time the market. And more importantly, it eliminates the psychological terror of investing a large lump sum right before a market crash. You set up automatic transfers on payday and never think about it again. The automation removes emotion from investing, which is crucial because emotion is the #1 destroyer of investment returns. Now, let's get personal. I'm going to show you 4 real-world scenarios so you can find yourself in one of these examples and know exactly what your future looks like. Scenario 1. You're 25 years old earning $50,000 annually. You invest 10% of your salary, which is $417 per month. Over 40 years at 8% returns, you accumulate $733,400. Using the 4% rule, that generates $29,336 per year. Add Social Security of around $25,000 to $30,000, and your total retirement income is $55,000 to $60,000 annually. That's a comfortable retirement with money for travel and hobbies. Scenario 2. You're 40 years old earning $70,000, and you're panicking because you started late. You invest 15% of your salary, $875 monthly. Over 25 years at 8% returns, you'll accumulate approximately $437,000. The 4% rule gives you $17,480 annually. Combined with Social Security, you're looking at $42,000 to $47,000 per year. It's not luxurious, but it's adequate and livable. Scenario 3. You're 25 earning $35,000, maybe just starting your career or working a lower wage job. You invest just 5%, $150 monthly. Over 40 years at 8%, you build $262,000. That generates $10,480 annually, plus Social Security brings you to $35,000 to $40,000 total. You can survive on this in lower-cost regions, especially if your house is paid off. Scenario 4. You're 20 years old earning $40,000 and you're aggressive about your future. You invest 9% of your salary, $300 monthly. Over 45 years at 8% returns, you accumulate $1,047,000. That's $41,880 annually from your portfolio. Plus Social Security gives you total income of $70,000 to $75,000 per year. That's a very comfortable retirement with significant financial security. Here's your exact action plan to implement everything we've discussed. Step 1. If your employer offers a 401k, enroll today and contribute at least enough to capture the full employer match. Start with 6 to 10% of your salary if possible, and commit to increasing contributions by 1% every year when you get a raise. Step 2. Open a Roth IRA. Start with even $50 or $100 monthly if that's all you can afford right now. Step 3. Select the lowest cost index funds available. Look for expense ratios under 0.1%. Choose a simple allocation of 70% U.S. stock index, 20% international stock index, and 10% bond index. Step 4. Automate everything. Set up automatic transfers from your checking account to your investment accounts on the same day you receive your paycheck. Automation is the difference between good intentions and actual wealth accumulation. Step 5. Dedicate 50% of every future raise to increased retirement contributions. If you get a 3% raise, increase your retirement contribution by 1.5%. You'll never miss money you never had in your budget. Step 6. Rebalance your portfolio once per year. This means selling some of what's grown and buying more of what's underperformed to maintain your target allocation. Annual rebalancing forces you to sell high and buy low. If you found this valuable, smash that like button. Drop a comment telling me your age and how much you're planning to invest monthly. And subscribe so you never miss strategies that could add thousands to your retirement wealth. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.